Welcome to the Ken McElroy Show. Today we're going to be touching on three topics. We're going to start with the fact that Powell is done as Fed chair, and yesterday was his last meeting. Then we're going to move into investing in an area that only has one employer and the pros and cons to that. And lastly, we're going to touch on the Sunbelt versus the Rust Belt. What's the better investment, both short and long term? So first, let's jump into Powell. He is no longer the Fed chair as of May 15th.
It's been talked about. Obviously, Kevin Warsh will see. He the first thing he wants to do is change the way the PCE, CPI inflation is calculated, which would be really interesting because potentially, if it's passed, it means that inflation would automatically go down.
Yeah. Kevin,
just like that.
Kevin Warsh wants to change how inflation's read, and we actually did a live on this on Monday, so you should check it out on our YouTube channel if you haven't. But he wants to change how inflation's read, which is very different than what Powell has been doing. So we're expecting pretty big changes to come to the Fed and their decisions in the next few months.
I'd love to change the way my age is measured. Wouldn't that be cool? It's like, you know what? I'm younger now.
Or what if you could change the way your bank account was measured?
Oh, yeah. It's more. It's absolutely more.
But
in this case, it's inflation where you could just, move a few things around and all of a sudden, voila.
See, I'd like to do that on my spending budget every month. I could just take out certain things, because what he wants to do is take out the extremes. So if I could just take out of my extreme spending and we just looked at my average spending.
So let me just, we're going to go to first Venezuela, then we're going to go to Iran, and then we're going to take oil out of the equation. Because why would you have that in there? It's just so silly.
Exactly.
You know what I mean?
Yeah, exactly. Who needs that?
Who needs oil and energy in, inflation? Because nobody deals with that. You know what I mean? Nobody.
Just a simple outlier.
Yeah, it's just a small thing. Oil, it's really nothing.
Yeah.
Pay no attention to the man behind the curtain.
Well, we broke this all down, and it is very interesting. But, if they really do change how inflation is read, and they really do basically make it go back down to 2% based on how it's read, we could definitely have falling interest rates.
That's one way to do it. Post it on your website and then change the formula.
Yeah.
We will hit 2%.
Yeah.
Damn it.
Yeah.
You know what I mean?
So anyways, that's some of that new school.
But the real issue is not that. Obviously, it's why. Why do that? The real issue of we all know why, which is, the other side of the argument. Well, we're going to hopefully get lower interest rates as a result of that. If we get lower interest rates, it's going to unlock so much stuff. Like all these people that are sitting on these low rates. Home equity loans. People are hopefully, potentially can salvage some of these commercial real estate loans. So there's auto sales. Everything is kind of tied to interest rates, or a lot of things, I should say. So this is call it step one of two steps.
Yeah. And truthfully, it can help a lot of people too that can refinance. A lot of us investors are looking to refinance into lower rates. Some people are in a pinch, and it would help them also refinance into lower rates. So this is overall good for those of us that own assets.
Yeah, it is good. Yeah, don't get me wrong. I mean, I know we're making fun here, but it is interesting that the government, whether it's blue or red, doesn't really matter, just decides to, and they did this in 1983, 2002 to 2006. They've changed the PCE and the CPI and how it's all this stuff, and owner's equivalent of rent and all that stuff. So we really go into detail on our live. You should check that out. Danille and I just went off on this on our live on YouTube. So check that out as well. And now a word from my paid sponsor, Padsplit. Look, if you've been trying to make single family rentals pencil out in this market, you already know that the math can be tight. With high rates, properties that would have cash flowed 5 years ago now often break even at best. So what do? You wait on the sidelines and miss out, or maybe you find a better model? That's why I want to talk about today's sponsor, Padsplit. Here's an example of the math in some markets. A 4-bedroom renting for $2,700 as a traditional rental may be able to gross over $6,000 a month in a co-living setup through Padsplit, depending on location, occupancy, and costs. The same house can potentially more than double the gross revenue in the right market. And before you think, that sounds like a headache, Padsplit helps with member screening and rent collection while still allowing you to operate the property and make management decisions. This is one strategy investors use to try to make deals work when traditional rentals don't pencil. If you want to see the numbers for yourself, go to padsplit.com/hosts. I'll have a link in the description. Just run the math on the property you already own and see if it's a fit. You might be surprised.
So when people hear that a new employer is getting into town, everyone jumps on it and wants to be the new landlords where rents are going to go up and appreciation is going to rise. But is that the right strategy?
Well, it can be, it depends. So I've been watching this forever, as you guys know. We invest where obviously jobs are going, because without jobs and there's nobody to pay rent. So generally this is employment is one of the things that we track really, really, really close. Now, let's talk about why would a big employer come somewhere? Because I think you got to start there. So let's say you have a company, just put your, I'm an owner of a big business hat on. What would you be looking for? You'd be looking for wages, right, that are reasonable, not crazy. So that would exclude some of these big metros, for example. You'd be looking for housing. You'd be looking at proximity to where you're moving. You'd be looking for credits from the city or state or whatever, and tax credits or land credits or whatever they might be. So all of these things are, these things are years in the making, right? So when an employer lands somewhere, and by the way, that could be also a military base. It could be a nuclear plant. It could be a data center. It could be Amazon. It could be whatever. So those have massive ramifications on a market, on housing, on rent, on restaurants, on, whatever it is, daycare, just everything, right? Think about it. Like when you have that many people moving somewhere. So also it can work the opposite. So I think it's important that you look at that as well. So you're also seeing certain industries cut back. You're also seeing if somebody's moving, let's say 5 or 10,000 jobs somewhere, it could be that they're moving from somewhere, right? So it's not always just new growth, right? So you got to look at all of it. And so back to your original question, I think it's just important that you kind of paint that picture. There's risks, of course, right?
Yeah, well, let's just go to the phase where they announce it. By the point they announce it, that's not the normal. That's almost too late.
It can be, let's just pick on the Taiwan semiconductor, which is, we're in Phoenix right now, and that was a huge announcement. And it was several years ago, right? Under a different governor.
Mhm.
And so, and the thing is, it's really interesting. If you're in the real estate space, you're all over this issue. But the general public kind of isn't. Like, it's very interesting. Like, you would think, like you are, I am, we read this stuff, and everything we look at is kind of real estate related in one way or another. I personally believe that, right? Expansion, contractions, freeways, the way they move, employers, all those kinds of things, like things that go on, have some kind of real estate implication. If you really, really boil it down, almost every single article. And so, but these kinds of things, depending on what kind of coverage they get, you'd be surprised at how many people don't look at it. So the ones that jump on it, to your point, the master developers, right? Hardly ever the realtors, right? Realtors are like last to the game. But people that are looking for the commercial office. I have a friend that's doing 9 car dealerships out by there, restaurants. We have obviously we looked at a bunch of land several years ago for apartments. But to your point, got bid up fast, right? The commercial brokers are all over this.
Yeah, but when correct, they are. But when a normal investor, I think sometimes people look at it and they think, okay, there's this area, there's never been anything out here, the homes are cheaper. This employer, whoever that is coming in, and now that's a great area for me to invest in because there's a new business, and then rents are going to go up and property values are going to go up. But you have to get in when you do that on the very, very, very beginning because it's like a wave. Like once things already start going up, you might, catch a falling knife and buy something when it's
Right.
at the top versus when it was at the bottom.
Well, right. So now we're getting to, first of all, like that plant is, years under construction, right? And it adds people as it adds people, and they spill out into the economy. And, that particular area is going to be a huge, huge, huge new piece of Phoenix, right? As a result and anchored by that. Now, to your point, that's not necessarily good. And I'm a kid that grew up around the largest, listen to this, the largest uh, building from an employer in the world. Like I grew up in Everett, Washington, which is where they build the Boeing 747. All you got to do is Google it. What is the largest building in the world? It will say the Everett plant for Boeing. So I grew up here, right? And I mean, literally, it was 1 mile from my high school. And so it also brings people in. So over the years, I watched Boeing sales go up and down, wars come and go, demand, there was Airbus and all these other kinds of planes always vying for Boeing's, competition, right? Okay. So what does that mean? That means that I've watched workforces and payrolls go up and down and up and down for years when an economy is kind of centered around one thing, right? And that's not necessarily good. There was a time in Everett where if Boeing was cutting back, the entire economy was affected.
That's the only employer in the area and they're cutting jobs or
Yeah.
they're using AI now or they're on a hiring freeze or they're letting people go. That's going to directly affect the rentals around it. And you don't really you can't pull rentals from anywhere else. Where if you're investing more in a city center, you have a bunch of different businesses. And, if one goes out of business, there's going to be a new place there. And there's just different, all different kinds of people living there.
Yeah.
So while it can be good, if you catch on the beginning of this wave and you get a house really cheap and you get a really low interest rate and you're able to, drop your rents if you need to fill the space, it can be really good. If you're buying too late and you're short, you're tight on cash flow, you're on like $200 or $300 a month cash flow. If anything happens with the supply and also with the demand, now you're negative. And you're really focused on, the one employer to keep you afloat.
Yeah. And so we were talking about this over the weekend. Danille has clients, and as you do, they read, right? They're like, okay. I mean, this is a very, very, very smart thing to do as a real estate investor. You're saying, where are the jobs? Where are they going? All that kind of stuff. So it comes up, right? People are like, what about here? What about there? Right. And so it's interesting because I told her, we've made this mistake. I literally have managed properties next to, I remember, this was a long time ago, but the Hanford nuclear plant in Washington State, which is it's called the Tri-Cities. There's an area called West Richland. And when they decommissioned the plant, there was like 3,000 jobs that went away. Literally, they decommissioned the plant. And so the apartment complex that I had went from 100% occupied to, very, 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 very difficult to keep full. And I've seen it with military bases. I've seen it with, businesses move. And in fact, the corporate office of Boeing moved to Chicago after, I think it was in the 90s, the corporate, right? Not some of the manufacturing. So those little things matter. And now the interesting thing is, when Boeing moved from Seattle, I'm talking about the corporate headquarters, to Chicago, it actually wasn't really felt because the downtown Seattle area had all this other employment. And so that's what we're trying to say here is if you're you'd be better off in an area that has hundreds of small businesses that in a strong economy than relying on one.
But I also was looking, specifically in the Phoenix area, but anybody can do this where you're at. And the area that has the one employer, the home prices aren't that different and the rent prices aren't that different than the bigger part of the city. So to me, that's not, you would then only be banking on appreciation of the home prices and appreciation on the rents, which would be solely, on this one employer to do because they're probably not going to be building a lot of other things out that way. Or if you're in the city center, you have a lot more opportunity for rent growth. So to me, the only way that it would make sense to invest around a single employer is if everything was much less expensive and the rent growth and the rents were much less so that there was room to grow because you can bank on this too late and miss that wave because I'm sure when
Yep.
those houses first listed, they were much less because they're so far outside the city than they are right now.
Yeah, it's true. Like, and I've made this mistake. Like, I'll give you another example. Ross and I built a property. We still actually still own it. It's near the border of Mexico. And on the border is a military base called Fort Huachuca, and also one of the Border Patrol headquarters. Okay, so why is this important? Because what we've found is that when Fort Huachuca is deploying people out, it affects the economy. And when the Border Patrol is hiring or not hiring based on federal money, same with the Fort, it affects the economy, period. So you'll see house prices go down. You'll see rent prices go down. You'll see occupancy go down. All of that stuff. And so everybody's fighting for less people. And then of course it can swing back up based on administrations. And so that's kind of obviously there's a lot more in that town. It's a little town called Sierra Vista in Arizona. But you just got to be really, really careful when you're trying to invest. You want to make sure that you don't have those kinds of swings with employment because, like the Taiwan semiconductor, it's obviously a huge, huge, huge new shiny object in Arizona, and it's massive and it's awesome, and it's really, really good for our economy. But there are a lot of things politically and internationally and technically that can change an employer's direction. And I think that's kind of the point.
Yeah, what advice would you have someone that's kind of looking at a one business area, where they would be mainly relying on one
I
business?
just, I've seen this so much. I've seen it with construction. I've seen it with mining. I've seen it with oil and gas. I've seen it with tech. I've seen it with military bases. I've seen it so often. I've even seen it with universities and government jobs where, they shut down, move, grow, whatever it is. And I'll tell you, you're way better off to you be in a really diverse area. We were talking, for example, about where, right? And one of the areas that Danille's really high on right now is the area which was what would be called a failing mall. Like, I'm sure a lot of you guys are used to, aging malls. I'm going to date myself, but this is Kmart, Macy's, Sears, J.C. Penney's, like some of these old malls are in the middle of town, right? And so what happened here is a developer bought the whole thing, which is awesome because what happened all around it, restaurants, houses, because back in the day, it was the place, right? So I'm sure you guys all have something like that. But what they did is they bought this place, they ripped it down, the whole thing, right? Obviously, this comes with a tremendous amount of work on the development side, and so you don't just rip down something without a plan, but they ripped it down. They started to put it all back together. So Humpty Dumpty is getting put back together. So what's in there now? You've got an IKEA. You've got all these new, edgy, cool restaurants. You've got a Lifetime Fitness. You've got a Whole Foods. And the Whole Foods actually has multifamily over the Whole Foods. So you've got like all this kind of mixed use, open air, outdoor. So what it's done is it's breathed new life into this existing area. So Danille started buying in that area. And guess what? The home prices are now starting to go up and by the way, these, real estate, it's not a light switch, right? The mall sold several years ago to this big developer, took forever to get the city to agree on what needed to be done. And then they started the work. And so if you just track this, you could have been way ahead of this, but now everybody's like, oh, there's a Lifetime and a Whole Foods. I'm going to start buying over here. And to Danille's point, the home prices have already jumped, not maybe to what they will be and could be, but that's kind of the point, right?
Yeah, but it's also a safer area, in my opinion, because to your point, it's in the middle of the city. So there's tons of jobs around it. And it's already an area that people, want to be because they have all the entertainment and all the restaurants. Where when you invest in those one business areas, you don't have that. The only draw really is that business and maybe some businesses around it, like restaurants and some nail salons and things that have opened up because you have people living there. But if that one business closes, so I just think as an investor, you need to be careful when you enter those areas and your plan to enter those areas. And if it's tight cash flow, I don't think that area is a good area for you, because if there's more rental competition because more people have this idea, like I said, you're just relying on the one employer.
Yeah. And one of the things that you can just check is you got to focus on what's called walkability. So walkability means all those other things like the infrastructure. How long does it take to get to the grocery store? How long is it on a light rail? Is it, on a bus line? Is it, how long does it take to get an Uber? We used to live in a spot where sometimes Ubers would just
cancel
20 minutes and then they would cancel. Right now, of course, it's 5 minutes, right? So those kinds of things, those are little conveniences that are important to people. And so, I remember we used to, if you go to Scottsdale, like you would plan on being there the whole day, and you hit the dry cleaner, you hit the grocery store, you hit, all these kinds of things, and everything you scheduled would be because you had a long trek home. And I think a lot of you probably know what we're talking about. So that's walkability. And so, the higher your walkability, the better it is for your rental, right? Because again, all of those little things are a lot of times going through people's brains. They would rather pay, because if you have to drive a half hour somewhere and back every single day, it's expensive. So you start to look at all these little things, and all of a sudden some of those core areas start to look a little bit better.
When you even were talking that you guys looked at investing in certain parts of Texas and you decided not to because it was so reliant on oil and gas. And then, you can have a president like Biden come in and shut down production, and all of a sudden you're empty and have nothing going on. And then you can have somebody like Trump come in and reopen everything, and all of a sudden you're busy again. But it's really dependent.
Yeah.
You really don't know. And especially how the government is going right now with tariff. I mean, you could have tariffs come in and then say, this doesn't make any sense now for us to, produce them, or, there's so many things that can happen. So sometimes I just think investors jump on a bandwagon, and you really need to think of what it is you're jumping on, and if you want to be reliant on one employer.
You got to be careful. Yeah. I remember Midland, Texas, and North Dakota, the Bakken area. These are all areas, if you're an oil person, that you love, by the way. But when oil goes from 100 to 30 or 40, it makes a difference. So, so all of that kind of spills over to your point. So the key here, and I guess the message we're trying to tell you, is make sure that you look at it from a renter standpoint, and if that renter moves, how fast can you get another one? Mm-hmm. And because you want, it's like an 8-cylinder car, and when you go on the edge of town relying on one employer, you're really running on 1 or 2 cylinders, and you're hoping that the car can still run. Whereas, you might have an employer go out, and then another one come back in, and, you're in the mix of lots of different things. And, and it is all about income and all about people and where they want to be.
In our current real estate market, we have the Sunbelt prices coming down and the Rust Belt prices continuing to go up, because investors are starting to push towards the Rust Belt. But the question is that the right thing to do both short term and long term?
I think, maybe it would be cool if the Rust Belt will get a new name maybe after this, right?
God, I hate that. I'm from there. I hate the name
I know. All this Ohio, Michigan, areas of Pennsylvania. Just the idea of rust, means aging out, all that stuff. Detroit, obviously, you guys know the auto manufacturing. Danille's from Akron, Ohio, or
Yep.
near there. Or
Tires.
like, the air's depressed, right?
Yep.
We'd be
Yep.
back there. Cleveland, even beautiful right along Lake Erie there, but it really hasn't really like grabbed, right? But here's the cool part. It's affordable.
It is affordable, and there's areas that are growing. I mean, Columbus, Ohio is one of your fastest growing cities in the country, and we know we have a lot of investor friends that are investing in the Rust Belt. A lot of them are
I
investing in
invested in
Ohio.
Columbus. Yeah.
Yeah.
I personally invested with some people in our mastermind that with a collective that we have in some Columbus properties. Yeah. So I'm a big fan of. Yeah, I'm not going to call it the Rust Belt anymore. I'm going to call it something else.
Well, but the truth is, and you can make some of this 1% rules and different things work in these markets, and that's what people are doing is they're buying properties for less, and they are being able to cash flow a little easier than maybe in your Sunbelt. But we also talked to a lot of investors that have hit big snags in this method.
Yeah, oh, for sure.
We're going to have somebody on in a couple weeks who accidentally bought in the middle of a war zone in Cleveland. And then you have people that don't account for the additional weather and maintenance that these multifamily properties take on. Because in the Sunbelt, generally, minus if you have hurricanes, you have less weather. So you just have much more weather in the Rust Belt too. And I think a lot of investors learn that the hard way.
Yeah, and again, this is. I'm a huge fan of affordable housing, and as you guys know, we have an affordable issue. So. And also, don't forget, the Sun Belt is, call it Arizona, some of Texas, some of those areas, and those areas are booming, and those areas are growing, and it's all going to be based on supply, demand, and all of that stuff. So as we start to see migration either speed up or slow down or whatever, based on mayors and governors and politics and weather and all the things, retirement, all those things, immigration being another huge one, actually. All that stuff moves people around. We are seeing North Carolina. We're seeing Tennessee. We're certainly seeing Texas, Idaho. So these markets that are having people move in. There's also markets where people are moving out. And so you got to pay attention to where they're headed. And so why would somebody move to Columbus? Why would somebody move to Detroit? Why would somebody move to Michigan? Could be work, could be family, could be low cost of living, which is certainly a huge factor, I think, heading into where we're heading next. So I'm a huge fan of I guess we'll call it the Rust Belt. But it's going to be interesting because as more and more people move there, it could potentially push prices up.
Well, but that's what I was thinking. In our last segment, we were talking about one employer towns and relying on them. And, right now, I feel like the Rust Belt is getting a lot of traction. Like, you have to buy in Ohio, you have to buy in Detroit. But at what point is there too many rentals and not enough people? Because for decades, these populations have been declining, not increasing.
Right. Well, we were just actually this great comma. We were just walking last week with some of my partners in Texas, and we were talking about markets and talking about Kansas City, talking about Indianapolis, and Russ said, he's like, you know what? If you go back and look, there hasn't been any real rent growth in Indianapolis. And, it's not a market I really watch. I said, that's really, really interesting. He goes, we've tried. We wanted to be in that market for years, but we haven't seen that. I certainly saw that in Oklahoma City. I bought property in Oklahoma City. I did see rent growth in Tulsa for whatever reason. Maybe I just got in the right area. Certainly it was in more of an affluent area called Broken Arrow. We did really, really well there. So you got to be careful, even in a Sunbelt market, right? There's Sunbelt market. There's areas of Arizona. You're not going to have rent growth, right? Like, period. We know that because we live here. So it's not just even though Arizona would be considered a Sunbelt state, it does not mean you're going to get equal rent growth. Like Tucson has been slow and steady, wins the race. And Phoenix has been kind of up and down and up and down and up and down. All right. And Flagstaff has actually been steadily growing as an example. Those are three very different markets. And so you're going to find that in Texas, you're going to find that in Ohio, you're going to find that in Michigan, you're going to find that all over. So you really got to be nuanced and know what's really going on in your market.
Absolutely. Like I know Columbus is growing a lot faster than Cleveland on rental growth and everything else, and even Cincinnati. But I just think with people, it's like that. It's almost like the headline for the semiconductor plant, where it's like the new spot to invest is now the Rust Belt. Is now Ohio, is now Detroit, is now certain parts of Pennsylvania. And so people just do that. But what you do want to look at is make sure you're cash flowing 100%.
Yeah, always.
But also, if you're in a declining area, that's different than investing in an area that's continuing to grow, because you could actually have rent declines potentially if there's too many investors and not enough renters. So there is this weird, and there's a much smaller bar to entry as far as home buying, because you can buy a home in Akron, Ohio for $200,000. And so,
And what's the rent there, though?
but the rent there can be,
Yeah.
$1,200-$1,300.
Yeah.
So, I mean, it's a good percentage, right? Because I'd say if you bought a $200,000 house, you probably get about a $900, $1,000 rent. So it's not like you're going to get, like, I'd say, you'd have to go a little nicer to get a little more
But
rent.
it's really interesting. So we bring up a really interesting point. Let's just pick on Ohio for a minute. You got Cincinnati, Columbus, and Cleveland, let's say. And let's say a home builder built the exact same home in 1990, a 2,500 square foot home in Columbus, in Cincinnati, and in Cleveland. All three of those homes, the exact same home, would be different prices, and all three of those homes would be different rents. The exact same square footage. Now, obviously, the submarket and the neighborhood and all that stuff have something to do. But all things being equal, you can take a home, and it can be very different. So it all boils down to the math, right? So a $200,000 home at $1,500 is tight. Right?
Mm-hmm.
At today's mortgage
Interest
payment.
rates. Yep.
Yeah, at today's mortgage payment and interest rates, right?
Yep.
But if you could buy a $200,000 home in Columbus, you might get closer to $2,000. But the question is can you, right? Like, I don't know. And can you get the 2,000 and can you get it for 200,000? The question is, that. So it all boils down to the math once again. Right.
Yeah, it always comes down to the math. But there's just something interesting in the Rust Belt and the Sun Belt, is that the Sun Belt is growing. So you're having a growing population where your Rust Belt is declining. Now, there's certain parts of the Rust Belt that are increasing, like the Columbus area. So you have to really look at the nuance of it. But as a whole, you just have to know if you have a dwindling population, that could affect things for your rental in the long term. Probably not in the short term, but in the long term.
We were just talking this week about the millionaire tax, right, up in Washington. So I'm from Washington, and we had dinner with some high school friends, actually. I had a bunch of high school friends that I was having dinner with, and they've done pretty well, and they're actually considering moving. And they're like and they listed off a bunch of employers that were moving, including Howard Schultz, the founder of Starbucks, and so you start to see, and then in Portland, there was another really, Dutch Brothers, also a coffee, moved to Arizona. And so you start to see these things as a result of people moving around. And I think it's just important to understand that it's not just, so when you talk about Rust Belt or Sunbelt or whatever it is, you have to look at why, because it's not just sun. It's, all the other things. It's affordability, it's low cost of labor, it's weather, of course, but it's also political environment. Mm-hmm. Like, how much are my taxes? How much are my property taxes? How, are you going to tax me on all these other things? I mean, California has been, obviously in the news a lot about, losing some big employers. So the real question is, as you watch all this, where are they going and why? Right. And so if you're, I remember a friend of mine, Doug Ducey, who was our 2-term governor in Arizona, he used to open a lot of his talks and say, Arizona is open for business. That was what he used to say all the time. And what that means is, we want you. We want you to move here. And, we're going to make it really, really easy as a state for you to move here and of all the issues that you might have. So as you start to look at those things, you'll start to realize that this is a real game going on. There's people that are frustrated with taxes, frustrated with crime, frustrated with, whatever else. And they're making decisions. They're voting with their feet and their wallets. And then what does it do? It helps you as a real estate investor if you're watching and you're like, oh, I'm going to go here. I'm going to get some rentals here because this employer's moving here and this is why. And so there are employers moving to the Rust Belt areas, and there are employers moving there for specific reasons because they're attracted there for reasons. And so if you can be ahead of that, you can do extremely well in this business. So if you guys are interested in taking a look at where we're looking, obviously you have to be accredited. We only deal with accredited investors. Just click on the link below.